G'day guys, Seeney here and welcome to another episode on the Australian Wealth Channel. And in this episode, we're going to be talking about what I think is going to happen with interest rates. So thank you guys so much for watching. Please make sure you like and subscribe to the channel. Really helps to get these videos out to more people. Now, there's been a lot of debate, a lot of discussion about what's going to be happening with interest rates going up. Now, people that own properties, some of them are really scared. Some of them are not worried at all. It all just depends on how much exposure you have to debt and what you think is going to happen with interest rates. So a little bit of backstory. The RBA, the Reserve Bank of Australia, is the one that sets interest rates in this country. Now, this is called the cash rate. And due to some very extreme economic times, the cash rate was dropped all the way to 0.1%, which is pretty crazy. It's very low. It's the lowest we've ever had in the history of this country, in fact. And what we've seen is inflation has been quite dramatic in this country. The RBA likes to see inflation around 2 to 3% because that encourages spending and keeps the economy ticking along, keeps people spending money and keeps the economy growing. However, something else is happening now that is really bad, and that is inflation. So instead of being 2 to 3%, what we're seeing is inflation that's more around 4, 5, 6%. Now, thankfully in Australia, it's not too bad. Over in the US, it's way worse. They're seeing readings of over 8%, which is absolutely massive. So thankfully for us, it's not going to be quite as bad. So what that means, however, is that the RBA has to crank that cash rate back up because what they need to do is slow spending and slow demand. Now, you might be asking, well, how does the RBA do that? How do they do it by lifting the cash rate? So what happens is when the cash rate is lifted, that means that the banks are very likely to also lift their interest rates along with that. Now, what that means is that mortgages get more expensive. So let's say you own a home and you have the place mortgaged and your interest repayments are, say, $1,000. When that rate is cranked up, it means that you'll be paying more in interest on your property. And what that means is that there's going to be more money coming out of your pocket to service that loan. So what that means is that you have less money to go out into the economy and spend on other things. Now, what the RBA is doing is they're trying to slow demand. Now, of course, anyone with half a brain knows that this is a supply side issue and there's a lack of goods rather than demand. Demand isn't really that much crazier. It's very much a supply side thing. The RBA is like a blunt object. They don't have something that they can do to control the supply. So all they can do is crush demand. They need to make everyone poor to make this inflation slow down. They need to stop the spending. So that is what we're seeing. The RBA is continuing to increase the cash rate. So we've seen some pretty dramatic rate rises, 0.5, 0.5, 0.25, and we've seen the cash rate go up from 0.1 to 1.35 so far. Now, the question is, how much higher is this going to get? Because we know it is going to continue to go up. We just don't know how much. Now, you might have seen online that there's a lot of the doomsday predictors have come out and said that this is the end. The time is now, it's all over. Interest rates are going to 10%, they're going to 12%. I can tell you now, that is not going to happen because the RBA will reverse course long before that happens. This inflation issue will be worked out well before then. Now, I've talked to a lot of people that do a lot of work in the finance space, and generally the consensus is that the cash rate will probably get to 2 to 3%. I personally believe it's going to be right in the middle of those two. I think it's going to be about 2.5%, which means that mortgage rates, when they're said and done, have probably got another 1% and a little bit to go from where we are currently. So if you're paying, say, a 3.2% rate on your mortgage currently, you can maybe expect a 4.5% by the time this is over. I wouldn't expect it to go much higher than that. But of course, you do need to be prepared for any situation because we don't know. what's going to happen. Inflation might get worse. It's very unlikely because supply shortages are starting to ease up, which is fantastic, and that's going to continue over time. But it is important to have a big buffer. So with my properties, the ones that I've bought for investment, they're all cash flow positive. And I think that that was a very good decision, especially given the time that we are currently living through. Interest rates are going to continue to go up, and throughout this entire period, my properties are going to continue to pay me money, even knowing the interest rates are getting more expensive. So that's something that I think is worth noting. If you are looking at borrowing money to buy an investment property, it's really important that you have a cash flow positive one, because interest rates will continue to go. So something that is negatively geared now is probably going to get more negatively geared. And especially as the market starts to slow, we'll probably see a little bit of a decline in house prices, which is totally understandable, seeing that we've seen growth of over 20-25% in not a very long period of time. So it's important that, in an economic downturn, you can keep hold of a property because it's paying you along with that. Because if you have to let go of a property, you might be negative equity if the property market is starting to slow down for the next year or two. So it's something worth noting. So personally, I believe the cash rate is going to end up around 2.5%, but it does remain to be seen what's going to happen. So I'd be really keen to hear what your prediction is. Where do you think the cash rate's going to be? What do you think you're going to be paying on your mortgage? Because obviously there's a difference between the cash rate and the mortgage. Mortgages are a little bit higher, but I'd be really keen to hear what you think the RBA is going to set the interest rate at. Where is that going to level out at? So thank you guys so much for watching. My name is Seeney. I own about $3 million of real estate, so that's kind of my credentials. I own a couple of properties here and there, which continue to pay me money every single month and will allow me to retire completely without having to work in the long term. So thank you guys so much for watching. Please make sure you like and subscribe. It really helps get these videos out to more people. Share these with your friend, leave me a comment. I'd be really keen to hear your predictions. So thank you guys so much for watching. See you later.